liquidity in the last 10, 12 years kind of changed the game completely. Before it was, you have the demand cycle, credit cycle. So it was quite easy to forecast, let's say. And everything's changed after 2008. We're in an environment where or you choose to use fundamentals and you're not going to make money 100%, or you choose to ignore what you think is right and follow the trend for now. And now we're at level that you cannot step back on it without breaking everything. In the peak of 2008, public debt was like 8 trillion. We're at 37 now. You can't roll back on that. But it doesn't mean the system is going to collapse tomorrow either. The housing market has been frozen in the US for 3 years or been slowing down for 3 years. And it's not now that it's going to blow up. We're about to reach the inflection point soon.
You're watching Excess Returns. I'm Matt Zeigler, and I've got one of my favorite macro newsletter writers in the house. It's the Mad King himself, Remi Tetot. Welcome to Excess Returns.
Hey, Matt. How you doing?
Oh, I'm doing great because we have so much ground to cover. Probably too much ground, if I'm going to be honest. I started to summarize this latest piece from you, and that's part of why I wanted to get you on. And I was like, this is a 3-hour conversation. We're going to see how much ground we can cover in about an hour here. We're talking about desynchronized cycles and cognitive risks, I think, top level, but I'm going to drop us in right here. You wrote, fundamentals have lost their grip, liquidity has taken the throne, and the Fed now holds the match over an already heated economy. Poetic, I might add. How should investors be thinking about this? Not just the liquidity cycle in general, but where we are right now in 2025.
Well, the important thing is, why did I write that, right? And I could see, yeah, right. And that's, why is that? So I could see a lot of people saying on social media, okay, this is overextended, it's going to collapse, it doesn't make sense. And you see so many people saying it, and not only random people, you have like big names saying it as well. And you're like, okay, something is off versus the fundamentals. So what's going on here? Is the market wrong, or are these people wrong? Which one is it? And that's where I started to dig deeply. Obviously, what I realized is, and what is well known now, I think, is liquidity in the last 10, 12 years kind of changed the game completely. The cycle before, it was, you have the demand cycle, credit cycle. So it was quite easy to forecast, let's say. And everything's changed after 2008, really. From 2012, and you can see it in the chart. There's a lot of charts that start correlated really well versus the business cycle in 2012. And the reason is the liquidity. So it's synchronizing to the liquidity. And then we had that big injection in 2007. In 2020 with COVID. And that was like, basically, we're still running on that, because that was a lot of injection suddenly. And so it's I think we're in an environment where or you choose to use fundamentals and you're not going to make money 100%, or you choose to ignore what you think is right and follow the trend for now. And it is something I had to adjust 2 years ago. The data looks bad for a while. It's been looking bad for a while. Nothing happened. And 2 years ago, I had that thing. Okay, I'm not wrong. I think my framework is right, but it's not playing like I expect. So I need to adjust to that. And that's what I've done basically in the last 2 years, and kind of changed the way I look at things.
Another part that I think is interesting, and I know you slipped and said the 2007 before 2020, but 2007, 8, 9 is when we got the introduction of, hey, look, liquidity works. And can you imagine if we added, fiscal to this side of the equation? And then like 2020 was a complete game changer. After it starts in 2012, it goes crazy in 2020, and it lands us where we are today. Is that a fair assessment to say it reaches all the way?
Exactly. And now we're at level that you cannot step back on it without breaking everything.
Right.
And you can't. When I don't remember the number by memory, but I think in the peak of 2008, public debt was like 8 trillion. I think something like that. We're at 37 now. something, in those numbers, in that amplitude, and it's like you can't roll back on that. Are you gonna diminish that? You can't. You just need to roll over. You just need to it's quite a mess we're in, I think. But it doesn't mean the system is going to collapse tomorrow either. We've been given cards. We need to play them. There's no choice. Now you can play it smartly, take more risk or less risk, depending where you are in your life and the risk you can take. But yeah, I think we are right now going through crazy time, and gold price is saying okay, something is happening here, and we better be careful. Now, we better be careful as investors. There's nothing we can do. We have to ride it, and when we can convert to the right asset, but even then, selling to cash to what? Now it's debasing on a daily basis. So it's actually quite complicated now, I think.
I want to introduce one other part of a framework that you put out there that I really like. I think you call it, I'm looking for 3 continents, 3 policies, 1 fractured world. Can you explain what that means?
Yes. So what we are now is, and again, this is something I looked at because I don't know if you've seen in social media, you had the debate of, are we in a late cycle or in an early cycle? So people are like, okay, we're in a late cycle. It's going to blow up later. We're in an early cycle. It's going to go up for a few years. People are debating that. So I'm like, yeah, okay, I don't care who's right. But where are we really in a cycle in Europe? It's not only the US, it's Europe, US, and Asia. And when you look at it, just by looking at the rate in central banks, right? You see, so the BOG now is at 0.5% when it's been nearly negative for decades. China is basically free money at 1.4%. Europe went from 4.5% to 2%, or from 4% to 2%. And the US went from 550 to 425. So the US is still the higher rate, when the other ones, they're more like already ready to turn. So it's and that creating a world in different gears. So now if you think about it, we have 30 trillion of debt. Oh, the US has 37 trillion of debt. They have the highest yields. So they're printing money at 4% of that debt. More or less, let's say more or less, right? It's not all the high yield and stuff. So to make it easy. So right now you have the world currency is growing at 4% every year. Well, a big part of it, all that debt. That's what's happening. So now how do you play that, And what does it create? What does it create in terms of globality, I would say? And how does it play out with Europe, that is clearly slowing down, with Asia, that you have even in Asia, you have two speed. You have Japan that's hiking, China that's cutting. So it's like, it's really a mess everywhere right now. It's really what I call the desynchronized cycle. And what's needed now is the Fed to accelerate cut, I think. But even then, people are convinced themselves that accelerating cuts like in the middle of the cycle is a good thing, when it's not really. It's never been.
In line with that, and it's part of this whole late cycle versus melt up idea. How do we think about that? Because you can't think of the US just as like a one-off. And this is another part where I think you get agitated by this too, when people want to say, oh, it's like 99, or oh, it's like 2018, or oh, it's like whatever. It's the world doesn't have an analog to those years.
No, and that's the thing. People like to frame things to try to forecast the future, so they look in the past. It make it easier to create a framework and stuff. But we are going into uncharted territory. Yeah, there is not like So in 99 you had the craze around broadband and internet and stuff. The AI craze is different. It's a different level, because we're talking, before we were talking hundreds of billions of market cap. Now we're talking trillions of market cap. So it's a different old ball game together in nominal term. And I think in tech, for example, now because it's accelerating, right? the next phase is going to come very quickly, and the next phase is going to be robotics and then quantum computing. This is coming already. That's going to be the extension of the AI mania and craziness that we're seeing now. It's a structural build-up, and we know it's going to blow up at some point. It always does, and that's going to give the way for the next wave.
Does that pave the way just for more melting up, do you think, or is it just?
Yes. Yeah, I think so. I think not on, AI is going to grow, not on necessarily on generative AI. I think there's a limit in terms of users for that. But I'm using AI a lot in a lot of different systems. And I think it's absolutely amazing the productivity you can get. So the next thing is, and you see it in Japan already, AI is going to be there. It's going to be used to replace aging demographics. This is happening right now in Japan already with AI, with robotics, with all of that. Now, if Japan succeed, because they're the one with the biggest problem, population is shrinking already, and it's well known, that problem, right? And I think they're creating the blueprint for that issue. Now, if they succeed, there is no reason he can't go to Europe, he can't go to the US, or he can't go to China. Well, China is a bit bigger in terms of population. But, Japan is quite a big scale already to build it. So if they succeed there, I think, it's going to be fascinating. And therefore, we're going to have more AI, not to create more content, but eventually to replace people in the jobs.
Well, we'll take it to not just create more slop in the world.
Please, no more content. We're good.
All right. Another place that you surprised me on this was with housing specifically. And I think I'm shifting really to the US on this one. You called housing the next driver of the cycle, not the risk.
Yes.
Break that down. This is a good counter take.
So if you look at the business cycle, as you know, and I'm not sure people know about it. I use a lot the business cycle in my framework, because that's what I've been taught. And so normally the housing correlate quite good with ISM, for example. And if you look at ISM versus housing price or whatever, you can see that the last 3 years, ISM has been in contraction. Housing over the same period is stopped growing because prices were too high in the US. And we still had some data that versus ISM in the business cycle went up. So you had that breaking correlation between some data, between not. And I think that's why we kept ISM stayed low, because of the housing freezing, basically. Now, the housing market has been frozen in the US for 3 years, or been slowing down for 3 years. And it's not now that it's going to blow up. Now we're about to reach the inflection point soon. There is no, it blow up at the top, not at the bottom, right? When there is excess. Now, for 3 years, basically, the housing market, has been building resilience, and you can see it in the data now. In the stocks, it start to pick up, or it pick up stronger than other stocks, and that's because people are already pricing rate cuts coming, and that obviously that's going to be the first sector I think that's going to benefit from it in many ways, in different ways. So when we're going to have the cuts, it's going to be good. Money is going to get cheaper, inventories, all that stuff. But housing is going to start moving again, because it's going to get cheaper. Although the pricing need to keep cool again a bit more. But here's the thing. So at this stage, you have two choices: or the market adjusts and the price goes down, or you find a way to make the income of the people higher. It's one or the other. And I think the Trump administration, with the move in crypto, with the move on technology and everything they've been doing, they're trying to push the income higher. Now, is it going to go to the right people? I'm not sure about that, but that's the play. That's what's happening that's the play right now.
Do you see that direct line between interest rates and housing prices And then I know you see it differently in different parts of the country. Like this creates the opportunity, right?
Yeah, because you have different markets. In the US, you have the East, the Midwest, and the West. They're all different markets, and they're all at different level of maturity. Some are oversaturated. Some are based on a luxury market. It depends. Basically, you got to look and for which part of the market you want to participate if you want to invest, and choose which area you want. If interest is going to cut, well, interest is going to cut because Europe is doing it, China is doing it, Japan is different. So the US is going to do it anyway, and we know Trump is going for it. So even if they don't cut now with Powell, it's just a matter of a few months before he puts someone else that is going to cut quickly, and that's in May. So regardless, we have it coming strong. We're going to have it. When they're going to cut, a lot of people are going to refinance. Everyone that bought a home in the last 5 years is going to refinance. That's a given. All right, that's going to be cheaper. And that refinancing is going to create a wave of liquidity, or could create a wave of liquidity, I think. And then we're going to see how our market reacts to that.
You brought up crypto in this, and I want to pull a crypto quote that you wrote. I think this was in the altcoin season that wasn't. Crypto hasn't died, it's grown up. I think that's a really interesting perspective for where we are and this almost nuanced wealth effect that you're describing and how people are thinking about other assets. What's going on there?
Yeah. So again, on social media, everybody was looking for, okay, this cycle is going to play like the other three cycle, which is Bitcoin go up first, Ethereum go up second, and then you have altcoin season. This season is playing completely differently. And it was always going to be, that's going to be the case on that one. I'm going to explain why. So crypto always worked with narratives. That's how it's been sold. So the first cycle in 2012, 13, it was like, okay, that's that decentralized money. And it was only for geeks, very few people knew about it. But the core idea was it's decentralized. The government can't control it. Okay, we want that. It goes up, collapse 85%. Okay, the next narrative is, okay, now we're going to program monies. That's when Ethereum come up and all the ICOs and people start to make scam and frauds. But that's when you created Ethereum, Cardano and all that stuff. Okay, that's the second cycle. Go up, 80% correction again. Third cycle narratives. Okay, this time we have DeFi. You can make crazy yields. You have NFTs coming. You have VCs investing. We go up, correct 80%. Again, same story. What's the next one? So which take us to these narratives. These narratives. Now, think of what I explained in a circle. Okay, we went decentralization, ICOs, which is programmation of money, like Bitcoin. Then you have the DeFi NFT. Now this one, which closed the cycle, versus this, we couldn't be more centralized now in terms of crypto. So we went from decentralization to fully decentralized, where you have government support, political support, government support. You have ETFs, you have institutional money flowing, you have all of that. So now the circle is closed. There is no narrative left that they can come up to boost it, right? Like they did before. So you cannot, therefore, now, or we go sideways, or we go up, but at a slower pace. It's not going to happen like before. And the other thing that people tend to ignore, and which I think was a complete coincidence, is right before each cycle before, you had a global economic event that led to increased liquidity in a part of the world, Europe, Asia, or the US. And that happened in 2009, 10. Then you had Europe 2012. Then you had 2016, which was right after Trump got elected. Then you had COVID, and then you had now, which now we had nothing really. And that, everybody was saying, oh, it's going to be the same. We've seen it before, and it's not. It's not. It was never going to be like that. Because it would be way too easy now. And the first time it surprised people, The second time, try to take advantage of it. The third time, you're late, but you're lucky. There's no fourth time. It's like, come on. So yes, it's going to go up, but it's not going. We're not going to see multiple that as we've seen before. And then you have the underlying product. Then we can argue about a lot of things. Then in the end, 99.8% or 9% of crypto are absolutely useless, and will never go anywhere and do anything.
Does that make Bitcoin effectively, like literally, is Bitcoin now gold or a version of digital gold?
No, it's not. No, it's
Tell me
not.
why.
People need to frame things to justify their positioning. All right, so Bitcoin is decentralization. Bitcoin is gold. Bitcoin, it's for them, so they feel right to holding it. But Bitcoin or any crypto asset right now is nothing else and more than a speculative asset. That's it. That's all it. It's a new form of making money. Obviously, a lot of people made money, but I would not say it's gold. I would not say it's money. It's just that speculative asset. Now, that being said, I don't know if you own Bitcoin or if you ever used it. To transfer Bitcoin, you can transfer billions in a blink of an eye for cheap, for nothing, and it arrives in the next 20 minutes, right? That technology, which is crypto eventually, is really good compared to the current banking system we have. That is, to me, that's what it's not Bitcoin itself or the price of Bitcoin. I kind of don't care, but I do care about the system you can build, not on Bitcoin, but on the rest of the system. Now, Bitcoin was the first, is the most trusted for now. You have institutional buying it. You have Zeigler going crazy with it every time he can, raising money. So yeah, fine. Does it mean that Bitcoin is worth the money they're paying? Not necessarily. But the reality is, yes, it's true. It's a limited supply. Yes, it's been useful for countries like Turkey or Argentina to protect against massive inflation. But in the end, it remains something that's in a cloud. And again, like the stock market, for people that like fundamentals, they say, oh, it's backed by nothing, or that's irrelevant at this stage, because we're going to a phase of, look, we have data in the cloud. We don't have data in a computer. So we're going in that phase of the world where things have value, but we don't have it they're not backed, or it's different. The technology is creating something very different all over now. It's not just crypto, and it's something that a lot of people don't adjust yet well to it, and some maybe too overconfident over it.
So we talked about the narratives that everybody tells themselves about crypto and everything else for that matter. And I want to jump to this. You called this the era of fiscal dominance, where the marginal dollar strengthens government balance sheets, not speculative risk assets. So let's talk about positioning. Let's talk about how people think about portfolios under that quote, because that's really fascinating to me.
How people look at portfolio, I think you have, from what I observe on social media, right? So you have some people that I would say are in their 50s, 60s. They're like, okay, that doesn't make any sense. AI doesn't make sense. Crypto doesn't make sense. And then you have the younger generation that is willing to bet everything on the most volatile stuff they can. Well, that makes sense. They're young, they can afford to lose it, and they have time to make it again. So that makes sense. But here you really have a split world in investing between fundamentals, what's happening now, again, technology blurring all the lines that we know of. And what is also interesting is, whatever group it is, they have their narratives to justify their positioning. And what I don't understand is why gold will deny the right to Bitcoiners or deny their asset, or it's valueless, or the other way around. And Bitcoiners say, well, gold is worth nothing, which is not. We've seen lately with the run he had. But it's like, why do you even bother saying that? It's focus on your positioning, focus on why you own it. And if the guy next to you want to own gold, that's fine. Go there's nothing wrong with it. I think, and that is for any narrative, any asset. But at the moment, I see too much people saying, well, my narrative is the best, my asset is the best, and way that Bitcoin collapse and you're going to lose all your money, and way that gold is not going to overperform. It's just like, yeah, boring. I think people need to adjust a bit. So yeah, when you look into all that, and you have the liquidity on top of it, and the total and the debt, and it's like, okay, what do we do here? How do we deal with that? And I think you have huge you do have huge opportunities in market. You just need, now the difference is before you would trade the cycle, now you trade fiscal policy basically. That's all you got to do. And on top of the problem, I would say now on top of that is, regardless how good is your framework, regardless how good is your analysis, you're one tweet away from Trump to mess it up anyway. He's going to say one thing and suddenly markets are going to overreact. And in the next 2 days, he's going to change his stance and it's going to back up. We've seen it. And whatever is your narrative or your analysis, anyone, it goes up, down. We have that on top of that to deal with now. So it's it's not about being political here, but that's a layer of information that we need to deal with as investors.
On the private side, can the private side screw up liquidity in a way that policy can't handle? Like, I'm thinking of the private equity and private credit claims, some of that stuff. You have any thought on that?
No, I haven't looked into it. I haven't looked into it much. But yeah, how did the private side mess it up?
Well, I'm asking if the private side could the private sector basically mess up liquidity in a way that makes it even harder for government policies to operate? Could we have I don't want to say shadow banking collapse, but all these stories that we've heard over the last 15 years here.
No, I don't think so. What? If anything, what they're going to do when money gets cheaper, they're all going to borrow money to do buybacks anyway. So it's like that was the game before. They're just going to keep playing it. That's the game. It's been the game since 2010. The buybacks, has been accelerating. Buyback plus passive investing plus crazy liquidity. Well, no. First crazy liquidity, cheap money, company, buybacks. And it's from there. It's just like, yeah, we've seen. So no, I don't think for that, as long as they can keep doing it, I don't think it's gonna be messed up. Now, they would have been messed up if the high stay too high, the yields keep high. But now we know it's gonna go down. I think the bond market is saying exactly that. I think we're fine for now.
The policy commitment to quote unquote run it hot that's the most important factor here.
Yeah. And when you think about it, they don't have a choice. Their valuation is already overextended, most of them. Their revenue is if you look at the revenue, their multiples, the growth is limited anyway in revenue. If you look at it in nominal term, I don't remember now, I did an analysis 6 months ago about it, on the Max 7 and the revenues. And in nominal term, it's not possible to justify the valuation and reach the revenue even in 5 years. That will be trillions in revenue. We're not there. It's not possible technically. So meanwhile, if you don't want a valuation to go back down, there's only one way to do it. Borrow money.
I'm shifting gears. It's related to what you just said, though, because I want to talk about some of the AI and autonomy and specifically human capital. And you've had a lot to say about protecting human capital. You were talking about industrial labor laws and AI's cognitive implications, especially this risk of trading freedoms for efficiencies. Can we just talk about that a little bit? How are you thinking through this?
That's deep.
It is deep.
Yes, it is. So when you approach AI, I think, so now we are already in a world where you're going to have employees that or are replaced by AI. So that's the low. I don't want to say the low jobs, but the manufacturing and stuff in automation, basically in manufacturers. So that's happening. That has happened. That's happening. And then you're gonna have in finance, lawyer, whatever you name it. You're gonna have the world of people using AI and people not. The productivity of the one that are using AI is going to increase dramatically. I mean, I was talking to a big company not long ago that I did an IPO in crypto not long ago. I was talking to an executive there, and what he said is now all the coders are expected to use AI. Now, what we expect from them is 5x in productivity. If we don't have that, they are. So that's the world we live in. So now if you ask, there's many coders, they're going to say, well, I don't want to use AI. I trust only my code and stuff. If they don't use that for coding, they're gone. They're gone because someone is going to be, you become more competitive if you do it. So that is something that is happening already. Now, I would say the risk of that is, okay, if you good employees use AI, become more productive, there is a fine line between, okay, you're going to increase productivity, but he's going to stop thinking to do it. So he's going to go faster to solve problem, but eventually he's not going to use his brain as much because AI is going to do it for him. So at the moment of problem solving and knowledge and all that, it's like, okay, you get the knowledge, but the application of it, you still need to be on top of it. If you don't do that, then human capital is going to eventually become more dumber. Yeah, I think. And it's something I realized, don't remember. I think I was talking with someone. I think I talked to someone about AI, and they told me how they use it. And that's when I realized, I'm like, people are going to get, at the same time, more productive, but also could become more stupid. Right. And it's actually, when you start thinking about it, it's very, very fascinating, I think. And we need to be very careful. Or if you're in a company and you ask your employee to use it, you need to be careful. Now you're not going to see the difference, but in 5 years you might.
Do you think this is this a macro risk? Is there a tangible idea of how we think about this in a macro framework?
A macro risk, I don't know. You have no, I don't think that specifically, I don't think would be a macro risk, but it's more from a human side point of view, right? It's more that. The macro risk is more on robotics coming and AI really taking over a few jobs. That's going to have some impact. But see, now is the thing. Now they're going to say, okay, so you lost your job to AI. So from this point, you have two choices. Or you get AI ready, right? Or you do a business and you need to be AI ready, or you stay behind. There's no choice. So regardless of, most of the time, people are going to go through that phase. So the AI path is set. We're going to have to go through it. People are going to have to follow it, or they're going to be impacted by it. And it's going to have an impact on the way people think. That is for sure. That is for sure. And that's where the way models are trained, the information they use to learn is going to become crucial. And right now, we don't have too much transparency about that.
Any odds that we get protecting human autonomy as like the new ESG in the next 5 or 10 years?
Yeah. You know what? Yeah. That's going to be, well, put it this way, people losing the job or people refactoring to do new stuff and adapting to AI anyway, you're going to have to pay for that. And that the ESG of AI is coming. That's perfect. So every company that implement AI for productivity is going to have to pay higher tax for that, I guess. We're going there. That's actually that. I didn't think of that point. That's a great way to put it. the ESG or AI is coming to counterbalance the losses, the human losses. You don't have a choice. It's not like the government can pay for it, you know.
Somebody's going to quantify it sooner or later, or attempt to. And
So or you pay for it, or you start doing Great Sun style. What's a movie in France? There's an old movie in the 80s. I think it's Green Sun called. Do you know it?
I don't think so.
You don't?
I don't think so. Pulling one out on me here. All right.
I don't remember. It's no. I don't remember who made it. I remember seeing it as little. So well, basically they're eating humans.
Oh, like Soylent Green?
That's one. That one.
Okay,
In French,
okay.
in French is different. Yeah, that one.
Okay.
You know, they convert you into food and stuff. So,
yeah, Soylent
you
Green.
finance that, or we're gonna have to go there. You know.
Things I didn't have on my bingo card for today. All right, I want to talk about. It was really interesting. I'm glad you brought up the crypto as a clock, or as like this cycle, because thinking in narratives is one of the other parts that you apply to this macro research that I just find is part of why I like reading your work. You said we live in a world where truth drowns in noise, and narrative drives price. You got to have a real strong understanding of this. Similar to that crypto framework, do you see this in other asset classes right now? Or do you see other frameworks in the way these narratives are shifting?
Right now, it's been you know, we had AI obviously. Defense has been strong, you know, with multiple front and globally. So that was a given. The next one, the one that's we had space. Space is also decent, and now the one emerging now is quantum computing. This year it's been, and I think in the next 2-3 years it's going to go heavy. Now, and it's fascinating because quantum computing is not going to be ready before 15 years at least. But, you know, people are getting excited to bet on what can happen there. So it's extremely speculative, I'd say. Other than that, you know, the narratives is the investing framework, I would say it's quite, you know, when you summarize it to look at monetary policies, it becomes a lot easier. And then you just have to assess, okay, who is where. You know, Europe, for example, it's more defensive and green infrastructure. Asia, I would say, with free money and where they are now, because they've been in pain for a couple of years, I would say, you know, Asian tech is about to have a good boom with cheap money. Now, in the middle of that, obviously the US remain the US, and you know, it's the dollar asset, so it's the dollar, the US. So it's gonna keep going up, and then you have gold in the middle that you must have as a hedge of the middle of it, and all that is based on policies, really. You know, there's simple investing thesis that you can just justify using policies, and I can build your narrative with chart and that. So when it becomes that clear and easy, I think it's you know, it's a no-brainer in those cases.
Do you worry about, or how do you think about pulling the returns forward in some of these themes? Like in quantum computing, which you said it's an emergent narrative. People are starting to get excited about it. How do we think about how much of the returns get pulled forward and the excitement part versus...
That's the thing. You look at it with the old people, with the old time framework. We don't care about it. That's the problem. I mean, if you look at quantum computing revenue, some companies, they don't even make 4 million, 6 million. It's not even in the double digit or triple digit. It's not even in the billion, but they're already worth 4 billions, right? And quantum computing is basically the solution to problems that don't exist in a dimension that we can't see, right? That's what it is. So here we can sell a lot of things. You know, the pitch people must create must be amazing. The pitch around quantum computing. So now, is quantum computing change the world? I don't know yet. You know, I don't know. It's quite complicated. And I think it's right now, it's just a narrative, but the same that AI 15 years ago was just a narrative. Just markets or people need the next thing. Now, the next thing is quantum computing. It's been the last year already. I think I wrote about it at the beginning of the year, and it did well this year. Now, is it something I recommend to invest? No, but it is still a narrative that's emerging. You can see, people getting excited by it. And now, if you think about it, there's no many left narrative to emerge. I mean, what we have AI, we have robotics, we have quantum computing. Then we're going to have quantum computing in space. Then we're going to have quantum computing on Mars. And then we're good, I think. So that's the next step.
Is this part of where it's just you identify these narratives as they emerge, and then that's also where you basically have to almost throw fundamentals out the window and just focus on what's trends, what's moving, what's interesting?
If you want to invest in it, yes. I don't. Yeah. Now, I write about them. I show them investing possibilities, but I cannot recommend them personally. I can't do it because I know it's very speculative. Now, a lot of time I do that with the Mad King. Okay, here's an emerging narrative. You want to invest in it. I don't know your profile. You want to take risk. Here it is. And here are the fundamental that goes with it. And here are the weaknesses that are with it. So now, you at least you have a decent level of information, well structured, well built, well thought through, and then you can decide. But as a writer, I cannot, I think I did space. So for example, I did at the beginning of the year, I saw space as it's getting better. Your SpaceX, that's going great things. I'm going to put it as a trade. So I put it as a trade, go up 30%, go down 50%. Obviously, when it goes down 50%, I have people saying, why are you putting this trade? They're very speculative. They're very risky. And I'm like, okay, just wait for it. Then now, by the end of the day, now I'm good. Now it's pretty solid. And the way I've done it to be protected was, okay, I build a basket. I cover different kind of products in the space race. And one of them is going to work, they're all going to, at some point, work. They do a launch, you work, they go up 100%. Now that's the game. There is no fundamental yet. There is no revenue yet for some of them. SpaceX is quite different. But this is, if you want to build or you have a completely safe portfolio where you have gold, treasury, and some ETFs like solid, or you keep some. I think depending on where, again, it's all depending where you are in your life and in your journey, right? And you can have some more room for speculation. Now, the narrative for speculation, they're very easy. You have 4 or 5. They're very simple. So you choose one of them, the one that you like the most, the one that you like the fundamental, the one that you can relate to it. And then that is Bitcoin, space race, robotics, quantum computing. I wouldn't say AI because AI is quite late now. I think the other one are gonna have a better upside. And then they link to AI anyway, in some ways. So yeah.
Philosophically for you, why is it important to be aware of all these things, even if you're not going to invest in them now?
Because you need to know everything that's happening, right, in our business. You need to have an answer for everything, but I want to explore different themes when I write. And because I have people that I know are going to be protective. I have some that are speculative. And that's why now when I write, I'm trying, if you look at the piece that I have, I have the market stuff, the macro stuff, then I have some thing that make you think, and then I'm going to have some interesting thing to invest in. And I tend to balance, for the both side of the spectrum, investing spectrum. And I think, it's, and what I like is when I see a narrative emerging, is like, okay, is it really valid? Is there something behind it, or is it just like wind? And I like to, I don't believe what I see or the noise I see. So I tend to look into it. And when it's interesting, I write about it.
Covering all these places, another thing that I love is you're always writing about behavior. And I mean like the behavioral sciences, cognitive behavior, and how that emotional cycle sort of maps across the macro cycle.
Well, I think it's, this is something that that's another layer. And I think that's another reason why market are losing fundamentals. Now we have a lot of people using Robinhood, for example, 20 million, 25 million, whatever. A lot of investors that are not sophisticated. They don't know much, but they just like invest on impulsion or emotions. And they're going to take a lot of risk for it. So that is switching the market structure dramatically, right? We've seen it with the GameStop narrative against I don't remember which fund. So this emotional or behavior thing of the herd, of us versus them, is changing the game as well. And again, that's something we need to adapt to. So it means you need to be aware that people are using TikTok for trade recommendation or Instagram or whatever. Is it right? No, it's not. Absolutely not. And should you do it? No, you shouldn't. But a lot of people are doing it because that's the world where they exist. That's the world where they spend their time. That's the world where they get information. So, and that's not only for investing. That's going to be for I know people that start to have a philosophical debate about Palestine and Israel after watching 2 TikTok videos. And it's like, don't go there. Don't go there because you don't know what you're talking about. You've seen a video that, or most likely is going to be served through an algorithm to confirm your bias. So it's like, okay, this is the world we live in. So again, we need to deal with those cards. And all that behavior I just described, that I think, in a way, I think you can anticipate some move in markets. Or when you see training, they're going to train out, not because it makes sense, not because the fundamentals back it, but because people believe in it. Now, is it the right way? Is it a way I will do? No, I'm not. I'm for example, I miss NVIDIA because of it, because I didn't want to jump in the train. Like at the time, I didn't see the story obvious, and it's a saying that I'm like, okay, fine, then I'll just look on the next thing, and that's it. I missed that one, no big deal. There's always the next opportunity anyway in markets.
How do we measure getting late in that emotional cycle almost with markets? Does that play a role, or do we just kind of like ignore that? Do we think about this as like an emotional cycle in markets? Is there a sentiment indicator in here somewhere?
So that I wrote about that not long ago. So if you look at sentiment around the world of households and consumer, it's depressed or going down everywhere. But yet we have market at all-time high, almost everywhere. So here you have a massive disconnection between what the survey tells you, at least the sentiment surveys, versus the reality, right? So there is something going on. Now, I doubt that people trading on Robinhood are the one moving the markets much. It's still more of a professional thing, I think. But they do have that ability to change sentiment over. Well, we have to make money. We have to go after the Wall Street guys. You still have that mentality big time, And so they try, and I think I saw a chart about the amount of naked option they were selling at Robinhood is like, so people just go one way or for whatever reason, and it's something that puzzles me now. Some people, or they say they are, we don't know, they say they made crazy gain. They outperform a lot of people on Wall Street. Now, are they right? Does that make them right? I don't know. Do you trade? If you trade with the herd and how they do, is it right? I don't know. But some say it's working. Now, I don't know if it's working. It's not working for me, and I don't do it. So it's simple. But it's something that, again, you have to people have to take in consideration at the moment of investing. You can't think, dismiss it and say, well, those Robin Hooders, they don't know what they're doing. They just, yeah, but they still have the power to gather crowd. And that's when the information spread, and I'm sure funds now they have quants that monitor well, they have algorithms that monitor social media for, okay, what's picking up, what's not, what's talked about more and stuff. I'm sure they have that now it's in the tools. It's crazy.
We talked a lot about narratives, and I know investor education is a big theme for you. Storytelling for education and reading narratives are kind of two different things, but they're very related. What's the power of the importance of storytelling?
Well, if you build the right narrative for investing, and it flows like a story, it's easier to understand. And I tend to really, really go deep in the data. So when I'm going to build a narrative, it's not 2 charts, it's going to be 40 to tell my narratives. Now, usually at picking narratives, I'm not necessarily too early when I do it, but they're quite solid. They're extremely well thought through, from macro, from fundamentals, from a lot of things, a lot of points, sorry. And yeah, it's for me, it's something that always worked. And it's something that, and I guess that's how I work. When you're going to tell me, okay, you should invest in that, I'm really going to take the word of someone for it. I'm going to have to look, okay, what's the narrative here? Does it work or does it not? So I guess I transfer that, the need for me to justify taking a position into my work.
Is there a way, I'm going to let you cherry pick one if you want to cherry pick one, something that you've thought through recently that you just walk us through what that looks like, putting that narrative together? And then, putting together a 40 chart deck is a big test of your own logic to say, does the story?
No, that's a small one. That's a small deck, 40. So that's 25 pages. I like when I do that.
Yeah.
Well, for example, now I'm working on a narrative that market can't correct more than 30%.
Okay. Say
Pardon?
Say more. Explain. How are you thinking through it? More the process than necessarily the outcome here. Very
okay. So first, since 2008, you see the volumes. I saw a chart of volume, Google volumes, for example. They go down, but they were really high. 2009, 10, they're all the same. Everything changed. And if you look at all the big companies, they're the same. The volume collapsed, and they're all in the same range since 2012, more or less. What's that? That's passive investing, right? So that when market correct at some point, the rebalancing of passive investing and the flows, they're gonna have to go by. There's no choice. That's the way they're structured, right? So that's one thing. The second thing is, right now we're in the next 10, from now in the next 15 years, if we get a market correction like 2008 or a big one, you get an entire generation, and the largest cohort that get wiped out, the baby boomers, right? Who is in each government, still running each government in the world? Well, especially in the US, baby boomers. So until you have a real shift in politics, I think in terms of age, baby boomers are going to be protected. They cannot let their generation fall or collapse. And now they don't have time to make money back. They're retired. They need to get their pension, all of that. So from a demographic structural point of view, you have a very interesting situation here where really they cannot let the market go. They can't. And if you have I'm talking big collapse, right? If you have a big collapse, then that generation is going to completely, utterly, I don't want to swear, but yeah, we can say the F word there. And I think for that, so if you look at so here you have two things for that narrative. You have demographic and you have structural flows, right? So that's interesting things. And now that's where I start building my narrative and looking at in detail at it. And if you look at markets but beside COVID, since 2008, you don't have a correction more than 25%. Even I think the maximum we got was this year in April. I got 25, 30, something like that. And then he bounced clean. And if you put the trends and stuff, since it's insane, it's perfect. So I think when I look at the charts like that, I'm like, okay, there is something happening here, obviously. So the structure of the fund, the structure of the flow is changing. Now, there is also a reason from a systemic reason not to let it go, at least for the next 10 to 15. And now I haven't looked into it yet. It's like, okay, how do we benefit from that? How do we play with it? How do we position for it?
Because that ties it right back around to this whole policy-driven idea of put that front and center in how you're building the portfolio.
Yeah, because then you have, so if you use the policies, now based on the policies, you have, okay, you're going to have, for example, you're going to have technology that's going to go better. And that fits right into that. Okay, what's the flow through passive investing? The correction can be, we've seen it, they can be sharp, they're quick, 25, 30, and they bounce quickly. And every time that happened, if you looked at the news flow in the last 12 years, they reverted quickly. And it's like they're controlling how much it's going. Okay, let's push it back. Or let's, in 2022, for example, from nowhere, we had the ChatGPT coming in October 2022, and it changed everything. We were down 30%. And then you have the AI narrative that started. So, okay, what's going to be the next one? I don't know. But right now, so this year, we had the tariff collapse, right? Now, what happened with the Trump's policy around tariff is redesigning the supply chain, really. And, he's pushing people out of China. There's a lot of game theory in what they're doing, I think. And yeah, that's going to change the supply chain, and now it's going to work for the next 10 years. And you see it now. Now they're fighting strong, with China. And it's going to be, definitely interesting to watch there. And something is happening.
I've got a couple more questions for you before I let you go. I got to get your words in the hat on this one. The first one I want to ask, one of our standard closing questions. If you could teach the average investor one lesson, what would it be?
Well, I think that's interesting because that's going to be a summary of everything we said today. So I would say you got to filter the noise and choose the where you're getting your information, right? I would say do not invest or take a position on one chart only. You need to have fundamentals that goes with it. It's always, because now people like soundbite, like short. Yeah, they don't want to read. They don't want long stuff. They want quick stuff. And the easiest quick stuff for people to invest is a chart. Right? That's the easiest. Like, I look at it. Okay, that's good. I go with it. The fundamentals remain absolutely like, okay, chart is a start. It's not the end of it. It's the beginning of your journey. I think that's how it is for me every time. The other thing I would say is if you miss an investing opportunity, like, don't look back. There is always going to be the next one, and don't beat yourself up. That's fine. So yeah, that's interesting. That's exactly what everything we talked about today.
Good summary. Good.
Yeah, no, it's.
All right, one more for you. A take that you have, an opinion, investment, markets, life, or otherwise, that most of your peers would disagree with you on.
Right. So that's a tough one, because I have peers that are bulls and peers that have bears. And I cannot have a framework that both cannot lie or disagree with. This is not possible by default. Now, there's few stories. I think crypto is here to stay for example. Not because of I don't care about the valuation, as I said before, but because of the technology behind it. We see it now. We haven't talked much about it, but we see it now where the stablecoin is really embedding into Wall Street, and basically the stablecoin issuer are going to become the biggest buyer of US debt. I guarantee you that. And that is happening already. That is growing already, and all the regulation have been put in place for the last 6 months to facilitate that. So that's their way of finding new buyers of the debt. But we haven't talked into it. So, we have to talk about the yield that it generates, but I don't think we have time. I think AI it still have room to grow. So that's for the AI bears. I think regardless of the valuation and what they think, I think we got to go. We have room to go. There is some crazy product. So an example is, the new platform of the Mad King. A year ago, to build that would have been, and I used to run the tech team, so I kind of know, that would have been a team of 6 people. And the cost to build that would have been around, not far from $500,000, I think. The platform, the way it works, all the tech beyond that I used, and then it's all automated. There is AI integrated. There is, there is payment. There is a lot of stuff. All of that is very expensive, and we talked about it offline before. To redesign your chart stuff, you need a Figma designer, and then you need a decoder, and then so all those steps, you have all those people. Now, when you use your AI and you know what you're doing a bit, all that is gone. All that is gone. So, the platform you see, for example, the new one, I built it myself while I was writing, so on the side. So I had time to do it, and it's something that, when I do that, I realize, okay, this is gonna go crazy now. It's gonna change the game. We just now. I would say no. The race is okay. We're gonna see companies of 1 people, 2 people making 10 million, 100 million. Might get even an application that generates $1 billion in revenue. A 1-person application. You don't need backend. You don't need front end. You don't need tester. You don't need designer. You don't need any of that. So it's just a matter of time before we see that. And that will be because of AI. Now the tech, for example, the tech is not a cost, is not a hurdle anymore. So where do we go from here? Well, a lot of things can happen. And another thing that I would say is markets are going to get extended beyond what people think and beyond fundamentals. And it's something now that fundamentals, they will matter at some point, just not right now. At some point, they're going to catch up. But right now is not the time, I think, for the reason I explained before that, with demographic and flows and stuff.
All right, Remi, I know people now probably want to go check out this new website. I know you want to show it to them. If people want to bug you on the internet, where should they look you up these days?
On Twitter at the King Court, and they can look at the platform at themadking.com, which, you have a lot of things now in there. You can see the content. I think there is quite decent amount of free content. People can sign up and they can navigate and read free stuff. And and there's a lot. I've been developing a lot new stuff in it, which one amongst them is, when I build an AI engine, so you can discuss my content, but not in a way of, most of the AI agent, when they implemented, people say, summarize this, or give me the bullet points, or give me that. Now, the way I'm building mine is, no, we're going to think further together about it. I'm not going to summarize it for you. What I write is not meant to be summarized, or you miss the essence, really. And my work is very detailed. So, and so that's why now in what I write, I try to, here's a summary if you want it. And if you want to dive deeper, then you have the longer stuff. And I'm building as well a charting system, which I just can't sell my Bloomberg terminal because of it, and I'm very happy. It is that good for now.
Well, I'm excited to have you back to do a tour of the Bloomberg canceling chart program.
That'll be a good one, actually.
All right. Well, you got me. You got my attention here when you're ready to show me how this thing works. Remi Tetot, the Mad King. I'm so happy that you joined me here today. You're watching Excess Returns, and please go to the website, check out the stuff he's doing. If nothing else, and you heard him say it, even if he's not advocating or investing in it, he puts ideas on your radar and then gives you a framework for thinking through it for professionals. That is an invaluable resource. Remi, thanks so much for the time.
Thanks, Matt.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.